Hey everyone, and welcome to the channel. Today we're going to be discussing how to pay yourself in an LLC. Now, for purposes of this video, we're going to focus on single member LLCs. This means that you're the only owner of your LLC. There's nobody else involved. Now, to explain this, we need to go back and discuss how LLCs function as disregarded entities. For federal tax purposes, LLCs are disregarded. That means that there's no separate return for an LLC. The IRS doesn't view them as a legal entity that files a tax return, at least not if there's only a single member. If it's a single member, it's like adding a third arm coming out of your body. You're not a new person, you just have this other attachment. So as a single member LLC as an individual, all of that LLC activity is just going to be reported on Schedule C of your personal tax return. So some other things we need to discuss are definitions of a couple key terms. One is income. This income is what your business makes. So this is, you have your sales minus your expenses equals net income. So when I say income, I mean the net income. The other thing is a distribution, or some people call it an owner's draw. That's when you take money out of the company and put it into, say, your personal bank account. So let's say that you start a new business, you create this LLC, you make $10,000 in your first year. How do you get that money out of the company? Well, it's actually pretty simple. All you need to do, and let's say that you set up a business bank account and a personal bank account at the same bank. All you have to do is transfer that money into your personal account. Fairly simple. That's how you pay yourself. I often refer to it as, say, moving your cash from your left pocket to your right pocket. That's all you're doing. Now, if you want to get more complicated than that, we have to discuss the difference between income and cash. So again, you make $10,000, but let's say that you want to leave in $5,000 because you want to grow your company. So you take out $5,000 of cash. Your income is $10,000. That's what you're going to be taxed on, not cash. It doesn't matter the amount of cash that you took out. What matters is income. So $10,000 is going to be taxable. Remember, with LLCs, there's no entity level tax. The LLC is not taxed in and of itself. It's attached to whatever owns it. That income flows through to you, you pay tax at the personal level. So at the end of the day, it doesn't matter how much cash you actually take out of the business. Now, you do need to do some planning and some budgeting, right? If you have a serious business, you probably need to leave some cash in there for future growth. Maybe you need to buy inventory, maybe some kind of asset like a truck. That's all well and good. But you have to know that what you're going to be taxed on is that net income at the end of the year, not how much cash you bring out. I cannot reiterate that enough, because a lot of people think that, well, I only took $5,000 of cash out of the business, I should only be taxed on $5,000. But that's not how it works. You're taxed on income, not distributions. Now, there are a couple nuances I'd like to go over when paying yourself. When you do a distribution, it's a non-taxable event. It's actually considered more of a return of capital to you. That's why it's non-taxable. What you need to know is at the end of the year, that $10,000 is going to be subject to the self-employment tax, that 15%, both the employer side and the employee side of the FICA taxes. Now, this is on top of what you would pay for normal income tax. Like, let's say that your regular income tax rate is 20%. It's now 35% because you're going to have that 15% self-employment tax. You need to be prepared for that. I cannot tell you how many people I've seen that get this big tax bill and they have no idea where it came from, because what they've been doing this whole time is they're earning money and then they're taking it out and they're spending it on personal things. And that's all well and good. You can do that, but you have to be socking away money for that extra tax. Super important. So just to kind of summarize what we've gone over, remember, whatever income you make, that's what's going to be taxed, right? It's not the distributions. The distribution is a non-taxable event because you're already paying taxes over here. There could be other considerations as you go along in your business. You might need to fluctuate how much you're taking out of the business because you may need to budget and purchase something else. So one of the benefits of the LLC is that it's very flexible. You can do things like that. So remember, every one of our situations is going to be a bit unique. We're all unique snowflakes in our own way. So remember, I'm a CPA, I'm not your CPA. It's always best to seek counsel from a tax professional or another CPA to determine what's best for you. Well, everyone, that's going to be it for now. If you found this helpful and you feel like I've earned your subscription, I would greatly appreciate it. It really helps the channel grow. As always, I wish you the best in your business and tax journey. Best of luck.